So today we want to use the data. We want to be insurance actuaries. We want to say, based on the data, what does it look like we can expect? Where are there opportunities and where are there threats? Because there's a whole lot of threats out there that we need to be careful of. So the first thing I did is let's take a look at the valuations of the market. There's a lot of ways you can value the market. The most popular one is the PE ratio, price divided by earnings. It makes sense. A company is the value is represented by its future stream of earnings. So a good way to value it is price to earnings. By the way, Warren Buffett prefers price to cash flow. That's his insurance background. My accounting background says I prefer price to cash flow. But cash flow is really, really hard to calculate, and they don't tell you what the S&P 500 cash flow is. So we start with price to earnings. And so what I did was I took a look here at the 10-year returns based on the starting PE ratio. And you can see here, there's a downward sloping line. Here's your starting price earnings ratio across the bottom. Here's your 10-year return. So you could pick a point. Here's the average. About a 10% long-term return, starting PE ratio right around 17. That's your average. What this chart tells us is the higher the valuation, the lower your expected returns are. And I put a couple boxes there. Every period where we had returns half the long-term average came with a starting PE of 20 or higher. I helped you out and I put where on this regression line we are today. We're right around a 24, 25 PE. Even with the drop to start the year, the lowest the PE ratio got was 24. That tells us we should expect below average returns. If you look at the best periods, the times we got higher than 10-year returns, Peter was talking about the 90s. When the whole 90s bull market started, we were at a low PE. So those people got very good long-term returns. So this number here is telling us, be very, very careful. The price-earnings ratio says our expected returns for 10 years are going to be low because you're paying a very high price right now. But as a former accountant and banker, just like Mr. Buffett, I don't like earnings. It's really easy to manipulate earnings. It's easy to throw out things. Right now we see companies say, no, those pension costs, that's not a real operating cost, so we're going to ignore those. And so the price-earnings ratio is always skewed a little bit high. It's harder to make up your revenue or your sales numbers. Now we've seen some companies like Enron or General Motors who was selling stuff to their dealers, and then their financing unit was guaranteeing that they could sell it and could buy it back. But it's really hard. Price to sales is a much better way to look at the market. So here's that same relationship. Again, your starting price to sales ratio, your expected returns over the long run. And again, same relationship. The higher the price to sales, the lower your long-term returns have been. You look at the average right there, 10%, price to sales right around 1. Where we're at today, we're looking at about a 1.6 price to sales, which tells us our long-term 10-year annualized returns are 2%. How many of you get excited if I said you can expect somewhere between 2 to 5% for the stock market? Nobody? That's what the data tells us. That's really important. That's what the data says. Let's look at something that is even harder to manipulate because it's based on the overall economy. Back in 2004, Warren Buffett was asked, what's the best indicator of stock market valuation? And he said, well, it's based on economic fact. The overall value of your stock market cannot exceed the overall value of your economy over the long run. Because you'll have times where you see really, really strong companies, but at the same time you have companies failing. So the average output of your economy is the average of the market. So the times where your market cap divided by your economic output is higher, that's when it's risky. The times to jump in are when the market capitalization of your market, your stock market, is below what the economic output is. That gives you that long-term potential. So here is the Buffett indicator, which is what they named it. You take the market cap, which is the total value of this U.S. stock market, divided by our GDP. Same relationship. And you could see, again, your very bad periods, in this case, negative returns over 10 years. Peter mentioned that when he started. That's come when you have a high market cap to GDP indicator. Your best returns, when Warren Buffett wants to buy, is when his indicator is up here. Plus 10% annualized returns. That's what we're waiting for. That's when he puts cash on the sidelines and says, I'm going to wait for a better opportunity. Where we're at right now is around the 0% potential return over 10 years. You can't manipulate the market cap. It is what it is. GDP, $17 trillion economy. We're not China. We don't make up our GDP numbers. They do the best they can to measure our GDP. And he's laughing here in the front row. But get this, okay. Our GDP comes out. The first reading is 1 month after the quarter. And then we have another reading 2 months after the quarter. And then the third final reading 3 quarters out. Okay? And then up to 5 years later, we might see some revisions to that number as the government goes through tax records and says, okay, this was our actual economic output. China, on the very last day of the quarter, puts out what their GDP number is and then never revises it. Which number do you think is a little more accurate? It's really hard to measure the economy, but from what I've seen, the US does a really good job of doing that. It's not perfect, but it's really hard. I mean, if we're talking about 17.1 versus 16.9 trillion, that's a good reading of the economy. So it's hard to manipulate this number, and it's saying stocks are valued so highly, our potential returns are not very good right now. Wise investors would listen to the Buffett indicator and say, let's wait to jump into the stock market because there's going to be times to get in. Now, going back a little bit, I want to talk about the risk. We talked about the potential upside. This shows the spread in returns, the range that we've seen happen over the last 15 years for the market. And let's look at 2 different things. We were just talking about the stock market, so let's only focus on the right side of the chart there. The potential upside of the S&P based on where we're at right now is everywhere from 0 to, let's call it, 6. That's your potential upside. Your potential downside is 43%. That's based on the historical range of returns. It's happened. In fact, it hit 50% twice in the last 15 years. So now let's think like an insurance actuary. If I told you you have a potential return of 0 to 6%, but you might lose 43, is that something you're willing to do? But if you're jumping into a buy and hold stock investment right now, that's your risk-return relationship. That's those threats I tell you about. That's what you're looking at. Now at strategic equity, we understand there's a lot of risks involved. So we're trying to shrink that. Here's our growth program, which invests in a lot more than just S&P 500, but it's invested in the stock market. Large cap, small cap, mid cap, value growth, international stuff. It's shrunk your range of returns, but there's still risk in there. The potential there, though, we're only about half invested. Our growth program is half invested because we know there's threats out there, and it wants to be like Mr. Buffett and have cash available so when those opportunities are created, we're there to jump on them.